Waking up, fire in the soul, shots on the screen, taking full control. London session calling, the volume is high. Watching the candles, reaching for the sky.
Strategy locked, no room for doubt. I know what the movement is all about. From the one-step plan to the two-step challenge. Finding that edge, keeping the balance, no distractions. Phone or silent mode, deciphering the market, cracking the code. Precision entry, the setup is clean. Living the life inside the machine.
Patterns forming, packets call. Balance base draw down, standing strong through it all. Risk defined, profit inside. Seacrest Markets guiding every step into the light. Seacrest Markets leading the way. Making a move every single day. Charts in the vision, strategies align with every trade. Our future is defined. Charts in the vision, strategies align with every trade. Our future is defined.
Let's talk execution, let's talk speed. The crystal clarity is what we need. Some is action, just the price as I see it. If you dream of the top, then you gotta be it. Spreads are tight, the conditions are prime. Scaling up the ladder, one trade at a time. Global access, yeah, we worldwide. We're the brokerage back firm, right by your side. It's not a gamble, it's a calculated risk. Reviewing the data, checking the list. Green on the screen, yeah, the feeling is grand. The power of the market in the palm of your hand.
Master of the pulse, heart rate steady. When the window opens, I'm already ready. No revenge trading, no chasing the rat. Following the logic, the plan in my head. The market is a mirror, it shows who you are. Trading like a pro, reaching for a star. Seacrest is the vessel, the compass is true. Breaking every barrier, breaking on through. Discipline and patience, the tools of the trade. This is how a lasting legacy is made.
Chasing the sun from the east to the west. Put the strategy through the ultimate test. Sydney is waking while New York is sleeping. Watching the levels, the promise is keeping. Laptop open by the ocean shore. Every pip gained is an open door. No 9 to 5, no shackles, no change. Just the cold hard facts and the capital gains. From the rooftop bars to the quiet floor. Seacrest Markets gives you so much more.
Patterns forming, markets call. Balance base draw down, standing strong through it all. Seacrest Markets leading the way. Making the move every single day. Charts in the vision, strategies align with every trade. Our future is defined. Charts in the vision, strategies align with every trade. Our future is defined.
Then the lights let the candles glow. Watching the Fibonacci start to show. Resistance turning into support. This is the craft, this is the sport. Back tasting nights in the early mornings. Heat in the trends and the volume warnings. It's a chess game played on a digital board. Striking the keys, striking the chord. Elite mentality, top tier tech. Seacrest provides the ultimate check. MT5 or match trader speed. Technology serving the traders' need. Daily limit set, max allocation. Building up capital, pure dedication. It's more than the payout, it's more than the gain. It's the freedom we build, breaking the chain.
From the first deposit to the maxed out account, watching the influence and impact mount. We're the new era, the elite of the screen. Navigating depths where the giants are seen. Seacrest the name, the gold standard inside. Turning every vision into green light.
It's a mindset,
Keep grinding,
it's a lifestyle.
keep crushing. We own the vision. We own the flow.
Welcome everyone, Seacrest Markets Live. I am your host. I'm just sorting something out. I noticed there was a glitch. But I am your host. Welcome. Monday through Friday, same time every day until it's not. But overall, markets are doing really good. I noticed that my screens have just changed. Give me a moment or two. Why has that happened? I know that bit's awful on my screen, isn't it? Sometimes my screen's disconnect, and when my screen disconnects, it creates problems on my desktop for my tiles. And no matter how many times you put them into categorized baskets and different folders and different files, when something like that happens, it all just goes up in the air. I think it might be one of the HDMI cables that I run. I have a feeling it is. I'll try and get to that at the weekend. Overall, markets are still kind of in the third day of panic. I think there's a lot of military I don't even know why I said the word think. You know, there's a lot of military conflict at the moment across US, Israel, and of course Iran, which continues to escalate. We're definitely seeing historic divergence between Asia and European equities. We're seeing that the free fall of states, while gold, oil are testing multi-year or all-time highs. De-escalation is definitely good because obviously we want to see that. But what was really funny is, or should I say, what was really questionable was there was comments around de-escalation. Now, de-escalation is bad for gold, right? Bear in mind what I just said there. Yet, I don't think the market actually believed there was any de-escalation, even though there was comments of de-escalation and there was tones that the markets were going to accept a de-escalation. But we saw gold rally. Now, a de-escalation of war is bad for gold because it's not a safe, there's no requirement for a safe haven, We're definitely seeing a shift to a war economy. You know, there's conflicts, there's Hormuz, there's insurance premiums, lots of hostilities. And I think when you really think about it, like we were talking about the Asian markets yesterday and how the majority of all markets worldwide were red versus some that were green. If you actually go back and look at the Kospi index, that yesterday plunged 12, overnight that plunged 12%. So you could say today because of the way the markets work. Now, I was reading an article this morning, and do you actually know, I'm just going to change my camera settings 1 second. Do you actually know that the last time the Kospi index plunged, towards that kind of 10-12% mark was 2008, the GFC, global financial crisis. Now, it's going to be a little bit different. I'll be completely honest. I don't think we'll ever have a 208, 209 scenario again. Not to the same extent. It'll be different. There's just far too much liquidity and buffers in place, whether that be Basel rules, whether that be bank contingency reserves, whether that be liquidity and borrowing confinements. But I know and I see how this is quite paralyzing for everybody, really. It's paralyzing for traders. It's paralyzing for families. It's paralyzing for the economy or economies. It's paralyzing for war. It's paralyzing for the world. And now, some of you may be wondering and asking, well, why did South Korea's Kospi index plunge 12%? Well, it's because it is extremely reliant on Middle Eastern oil. Now, what happened, it leads us on quite nicely. There's lots of rumors on and around the Strait of Hormuz, which is, of course, the singular water passageway for ships and oil transportations to and around the world. As we mentioned, Iran and the Middle East provide 20% of the world's supply. Now, 60 to 80% of that supply from Iran alone goes into China. Now, when you factor in the Middle East as well, you've got Pakistan, which is the neighboring country to Iran. That gets its oil from the Middle East. Now, they're going to have obviously big problems. The world is going to be affected. You know, even everyday consumers will be affected at the pumps for those that don't have electric vehicles. You will be affected at the pump worldwide. Now, of course, in the UK, you will see that increase quite significant because, of course, we have fuel duty and import, etc., taxes on top of the price of oil and gas. So we pay a significant surcharge to other economies. Now, the Strait of Hormuz has, like I said, had multiple rumors. Some say it's closed, some say it's open. Iran says that any ship that has not been cleared to travel through will be bombed, set alight, set fire to. They did give clearance to shipping for Chinese-bound shipments because, again, like I said yesterday, the relationship between Russia, China, and Iran is purely and clearly from China and Russia's perspective transactional. And Iran has figured that out. They are all alone in this war. Now, as I mentioned yesterday, North Korea would love to get involved. They keep talking about how they'd love to get involved, but no one wants them. He's just, unfortunately, a little puppet sitting on the side trying to get involved, which is a shame for him, not for us. But I think we have to factor in that the opposite side of the rumours are that the Strait of Hormuz is not closed. President Trump has stated that there will be escorts, naval escorts, not your escorts that you find in the markets on a Friday and Saturday night when you're out on the town. We're talking naval escorts, and there will also be further insurance supports from the US for tankers. That was announced late yesterday. So whilst insurers are still withdrawing the war risk coverage, it's going to be realistically keeping global shipping paralyzed. Which is, you know, without really kind of going into the nitty gritty, because there's not much more to say on the subject, it will cause major disruption around the world because, like I said, OPEC and other oil producing countries will have to pick up on the supply side. We've already seen that OPEC have announced that they will increase output and supply just to try and fulfill the demand. And again, that's good for them. There's going to be a premium on that. We all know that. We know where prices are trading at this moment in time. But we also need to factor in that the economic data will continue to wash out. You know, we've got China's official PMI that came out 49.5, which is a confirmed contraction. We had inflation unofficially put out there from the UK, which shows that actually it's more about 4.5%. We've got the Caxian PMI came out at 52.1%. 52.1%, which I would say, you know, in a time of uncertainty, that almost drives a glimmer of hope for private manufacturers in the US. ISM manufacturing also came out 70.5, which I would say, if the nail wasn't already in the coffin, it has already effectively killed any hopes for a spring rate cut. Now, we've been going on about these rate cuts for a while. Originally, we were discussing June, pushed it back to July, and now we're potentially looking at even September. Now, with rate cuts coming in play and ISM manufacturing coming in at 70.5, I think we realistically, unless something drastically changes, are looking at September for a rate cut out in the US. I don't think that will necessarily be the same for the UK, the BOE, and I don't necessarily think that will be the same for the EU ECB. I think the BOE will still cut rates in line, and I think we'll probably see half a basis point cut throughout this year. Yes, I'd like to see more, but I also don't want to do two things. One, I don't want to cut too aggressively, which is obviously two signs. One, if they cut too much too aggressively too quickly, that actually signals that the economy has slowed down too much, and now they're panicking. They're trying to, I guess, repair the hole when water's already coming out. You know, there's the bucket is massively leaking, or the ship is sinking. Cool. I nearly said the sink is shipping. That would have been awful. But the ship is sinking, and they're trying to put a band-aid over the hole to stop the water coming out, to ensure that the ship continues to sail and stays afloat. Alternatively, on that comment as well, and the second part to look at is, if we cut too fast, too soon, we could hamper any hopes of stability and a recovery in the UK. So rate cuts are good initially for short term, but also it doesn't necessarily mean, like, for example, you and I, normal civilians, normal retail personnel, that want rate cuts to come down because we want to reduce our borrowing costs. And that will be margins for mortgages, personal loans, private capital, car finance, if you have that sort of stuff, university loans, etc., etc. But, you know, that also depends on if these lenders actually honor the rate cuts and go with the base rates and then mark up the base rates, or whether they just hold firm because they think the market's overjudged and overpriced and move too quickly. Obviously, when the rates do cut, respectively, we will all be rushing to our lenders if we've got debt, because we want to secure the lowest possible deal. When, you know, back in 2010 through to 2019, rates were historically stupidly low. You know, I saw rates just above 1% on mortgages and fixed terms. I saw rates in 2019 at 2.01% to the client. Now, bearing in mind, majority of people are now either fixed at 4% or more. You know, that's a big jump. You know, mortgages were about, you know, £1,000. They're now £2,000 or more a month, which, relatively speaking, that's still okay. But unfortunately, when rates are high, you get it fixed. And what's really funny, and it really pissed me off, and the audacity of the banks, is the banks rarely, if ever, will offer a 30-year mortgage here in the UK, fixed 30-year mortgage, or a 25, it doesn't matter. As soon as interest rates were at 7%, they came out with their 30-year product. Imagine the poor souls that fixed at 30 years at 7%. Fuck my. You've literally been hung, drawn, and quartered. And if you've not been hung, drawn, and quartered, you've had your pants pulled down, you've been bent over, and you've been absolutely shafted. And I think you need to bear that in mind, that people believe that lenders are here to help us. And there was that spin on the whole story that lenders are bringing out a 30-year product to help you understand and stabilize your payments. Well, why didn't they bring it out when it was 1% or 2%? And it's because they can't make money at those levels. That's the thing, right? The majority of banks this day and age make the majority of their revenue through lending. That is the be all and end all. So it's a bloodbath, you know, and we can kind of talk about bloodbaths. Like Asia dropped 4% yesterday or overnight. The Hang Seng 1%. India crashed. I think it was like 1,700 points this morning. The Sensex, right? The DAX yesterday 3.5%. The FTSE yesterday, 2.75%. Now remember, the FTSE is 70% exposed to the US internationally, and 10% Europe, 20% is UK. So it doesn't necessarily mean the domestic markets are doing that bad. It's the international constituents and exposures on the FTSE 100. And the same for the DAX, okay? The DAX has got massive US exposure. So they, quite frankly, were battered yesterday as, unfortunately, energy prices and energy costs soared. The US markets fared fairly well, and I guess that kind of leads me on quite nicely to the question here in the channel. The S&P dropped just nearly 1% yesterday, and the Nasdaq dropped just over 1%, which it did pull back despite what we were seeing as a brief midday recovery. The VIX we spoke about spiked to 23.57, and again, what does that reflect for us? It reflects deep anxiety in investors. So let's talk S&P. We've spoke macros and geos and econs for, I'd say, long enough now. And I know I tend to drift on a little bit longer, but these markets are interesting times. There's so many of you that won't have, whoa, is something going on with StreamYard? Give me a second. Let me just check. I'm going to change. Okay. I saw a glitch. I apologize. So I'll just go a bit slower. I'll try not to go too fast. I don't know what's going on with StreamYard. So let's look at the S&P. We spoke about it. We don't need to talk about higher time frames for now. We know we're caught inside that 67 to 7,000 range. So 6,700 to 7,000 is our range, okay? We were looking at 6,720 being our floor, which is obviously the horizontal red line that you can see in between that negative 75 and negative 100 on the ATR. Right now, I just need to actually let me just get rid of some of my friends just so that we can actually see a little bit more intricately for the day. So I guess we need to consider a few things. Are we expecting the war to escalate even further? Do we think the US could lose this war? Let's be honest, you know, there have been predictions for that. There are comments that, I can't remember the cliche comment that I read. Let me try and find it. I had something on another tab. There were comments basically saying that you're fighting a country that's extremely slippery and nimble because of the drones and the tech that they've got, and you're traveling to them and they're not traveling to you, so they potentially have some form of advantage, which is quite an interesting point because Iran is on its own, and the US believe, well, there are comments around the world that states that they believe that the US could lose this. I'm not saying they are. Don't worry. I'm not saying that, and nor am I saying that for anyone that's in this view, in this stream, I am not saying anything about any country. I don't think the US will lose, though. But there are comments out there that say that, and I think when you read that sort of stuff, you just have to bear in mind that some people will put those comments out. You have to think about the water situation as well. Like, they know that they have these water reservoirs and these water tanks, and they don't have in the Middle East naturally clean water that can be run through filtration systems like certain economies in the Western world. So they're going to be a big target, I think. I think they'll be a big target in this war, because as soon as you take out clean and drinking water, or any water, that's a natural staple for a country. So they won't only be taking out their flight decks, their systems. The fact is the US has now confirmed that they've taken down 15 and sunk 15 of the ships from Iran. So they won't just be taking out their control decks for drones and their long-range missile programs. They'll be taking out HGVs that are disguised as standard HGVs rather than military transportation trucks. They will be attacking and targeting the oil refineries. They'll be attacking and targeting the government buildings. They'll be targeting the water reservoirs and the water units. And then they'll go from there to electrical and taking out their power, if not all alongside the water. So coming back to the S&P, we had that brief trade from the 68,700 level. Now, if we don't think the market's going to continue to escalate, we now have this area to contend with, which is essentially the extreme of our range. We've got the extremes of our range is always marked out from the left coming through to the right. And we've got this new adaptation. Now, this level isn't majorly strong. It's not taking anything out to the left, right? We've put in a new lower low from here, right? But we're still trading in that range. Okay, so we've still got this range over here. Oh, I went too quick. No, StreamYard, what are you doing to me? So we do have this break. I guess we could look maybe to tame this down into here. Just do this quickly because that's where we're mitigating now. Today I see higher prices. I think we could come up to 6860s to 6900. Again, what's up here at 6900? Extreme of leg, extreme of sell range supply, and also our favorite red box theory, which is around 6900 to 6920s. So that would be my initial targets for longs. I'm quite okay with taking longs from here. I'd have to be very cautious. I would size down massively because of the war. So I would comfortably looking at risk premium longs here from 6800s in towards 6900. I think, the way these markets are, momentum is showing that we do want further upside. My only hesitation and my only worry here, and this is why you're playing the risk premium, my only worry here is markets overnight this morning across Asia and APAC markets fell. So if the US wants to follow suit, then London is pretty much pulling us back to get short. Now, again, where are we going to pull back to? This is what I'm looking at. I'd happily look at risk premium longs into 6860s, 6900s. We do have that high, that week high at 6840s that I am just keeping an eye on, which is here, this level. But when we trade up into 6860s, 6900s, if I'm not long already, I'll be sitting on my hands. And when we get into those levels, I'll be waiting for either a shift in momentum and order flow and keeping an eye on volume from the CME to see if we shift short to continue to the downside to trade into the 6600 handle. Alternatively, I'll be looking to see if we can break above 6920s to start looking for potential reasons to continue longs to trade back up into 7,000. That is current theory for me. So hopefully that gives you somewhat of an overview, Ryan, on the S&P. I know that is from the hourly time frame. We can drift down into the M15 just to see maybe some intricate PA. So had this high, we break down, we then respect this, we break this, we come into this, which is all part of that, do this, come here, we then sweep. I know that's not the straightest of lines, that could be like that. Why is supply holding if demand isn't failing? So we've got this, and I suppose we could have got long from here. So I don't know where roughly you got long from. You said 6,800. So 67.90 is really where you start looking for your long. So in theory, you've done the right thing. You're getting in momentum. So momentum started to kick in and you're starting to take the continuation of that rather than actually getting at the peak low. And I think that's something, again, I need to remind everyone of. Trying to call the bottom of a move or trying to call the top of a move is extremely difficult. And in this scenario, it isn't necessarily deemed as your bottom. It's a retest of the break, which is also, a retest of a descending trend line. It's a retest of demand because demand has been formed and it's now retested that. So it is a safe place to be getting long from. Once momentum kicks in, it just gives you that confluence, that confirmation. And I guess you would say confidence. It's the wrong word. I don't really like using the word confidence because we're playing a probabilistic mathematical edge. It's not really confidence. You've got a confidence in your edge, but it's not confidence in winning. It's a probabilistic mathematical edge that we're playing out in the statistical moves as best we possibly can in a market that's derived from multiple layers and multiple skews. So targeting would be what? ATR 25, 68.20s, trading into ATR 50s, which is 68.40s. But as we get up into when I get an EM15, it's a little bit tighter here. 68.70s and not 68.60s. So I'd say about nearly 68.70, late 68.60s into 6900s, where the red box theory is. And that is if the market wants to push strength in. Obviously, we've got still the issues of war. We've still got the uncertainty geopolitically. The war is just a shadow over everyone's day. It's almost like, rewatching Oppenheimer, the film, when they first let off the nuclear bomb and just seeing that plume of smoke hover over our heads and be uncertain whether the atmospheric gases will absorb that and actually create a combustion of explosions in the galactic, which actually then releases a never-ending chain of explosions. I guess that's the fear we've got right now. There's hemorrhaging across the economies. Gold, obviously, we can talk about in a moment. As we know, it gapped up to 53.77 a troy ounce yesterday. We did see slight profit taken this morning, but I think it remains in an elevated state of hyperbolism, so hyperbolic standards with uptrends. If economists were as good as their calls, they would be multi-billionaires, but they're not. However, economists are eyeing $58.50 per troy ounce by April. Not saying they're wrong, not saying they're right, but bear in mind, again, if economists were as good as their calls, they would be traders and not economists. So we'll keep that paper trade ID there on the US 500. Those of you that are long around 6,800, you're potentially running at about 4 points roughly in profit. Gross, I don't really know what spread you're factoring in or any comms on that, but there is availability for you. Spread should be okay at the moment on indices. It's fairly liquid. Depth's quite good. So yeah, we'll keep an eye on that. Let's see how that pans out later in this week. We can maybe touch upon that in tomorrow's live session, which I just need to rearrange a few things on that. So let's go DXY before we go gold. Let's go DXY. Actually, I want to do VIX. I want to quickly look at VIX. Sorry, my StreamYard's giving me a hard time again. Really is. Oh, this is good. Oh, wow. This is good. This is good. This is good. So Yeah, this is really good. Yeah. Okay, so this is good. So we spoke about the VIX index yesterday. We spoke about how we expect higher volatility indexes to obviously continue to run with uncertainty. Obviously, we look back over the years, try to identify what actually is going on in the market. Let's come out to the daily. I have to just go slow. Give me 1 second. All right, good. So look at Tuesday. Tuesday's high on the VIX was 28 and a fifth, just under. And we retraced, which is good, which is a good sign, because had it have closed like Monday and traded up around 2800s, that continues to signal huge volatility and uncertainty in the index, and it usually means bad things. It usually means that the indexes are going to continue to fall. It means that stocks will continue to fall. It means risk products will continue to fall. Whether people are putting their cash into physical assets, metals, or whether they're investing and moving their money into cash, such as the US dollar or treasuries, or just pulling their money out of the markets, that is what you tend to see when the VIX continues to trade higher. But this shows a sign that the markets are pricing in somewhat de-escalation. You know, I think there still is a risk overall of global margin calls. It's still high. I think we need to keep an eye on energy and tech sectors if we are trading indices, especially for the S&P, because we're going to want to see what's going to drag the index down. You know, and the index drag could come down all the way to what, 6,500s if we break 68, 67s. Again, obviously, if we're long from 6,800, we would expect markets to pull back into something 68.40s, 68.70s, into 6,900s. And then we want to see the signals to get short. It could just be something like, I don't know, Iran has sunk a US battleship, or Iran has struck the USA. Russia has got involved. China has got involved. Iran has struck the UK. You know, what I am seeing, and I'm pretty horrified by it really, is Cyprus is defenseless. Cyprus is truly defenseless. And until earlier this morning, the UK were just sitting idle, not protecting British bases, Cyprus as a whole. And they were just relying on European economies to do so. And you know, Donald Trump came out last night and specifically stated that, one, he is no longer going to be doing any trade with Spain over their lack of support and allowance to offer US bases to basically train from, have their bases from, fire from, and be stored, use as storage. And he's also not happy with the UK because of what the UK has said. You know, they're not willing to back and support, and they're willing to give and provide, but they're not willing to actually back and physically support, which it just shows really that Keir Starmer is an absolute moron. I was watching a good show the other day, and it just reminds me of that Gordon, Chef Gordon, as we like to call him, Gordon Ramsay. He's got a TV show out, a documentary on his life, and it's a really stark contrast on success versus normal life, and being a father and being a family man, and also running businesses and being, you know, the F1 and all of this stuff. And there's a song called "Gordon is a Moron," and he said it reminds him of his childhood because he felt it was all about him. And I think that just comes into my mind when I just think about Keir Starmer being a moron. I'm sure he's a nice bloke behind the scenes, but politically, I think he's out of his depth. And I think most people in that scenario do find themselves out of their depth because they're not. They're trying to be too on the fence and be too socialist, specifically Labour. Anyway, so markets obviously trading down in a VIX at 24s. We're trading around that handle now. I'd like to see us trade back into 20s by the end of this week. That would be quite nice. You know, that really does start to show signs that we're really starting to trade down. If we can get back down into, the 15 region, then that's great. Let the rallies continue. But right now we're buying risk premium. So we're getting long, just like we were in April. Look at April. Just to touch upon it, I know we covered it yesterday, but April's high on the VIX was around 60. Risk premium buying. In October, risk premium buying. In November, risk premium buying. Not as much because they weren't big, but this was the biggest one. We could kind of see it here. Is this time different? Maybe. But we have to play the cards we're dealt, and risk premium opportunities are ever present. It doesn't mean that we are ignorantly long. It means we are calculated long, and we're looking for calculated ideas to get long or continue to be long or add to our longs. And I think times like this is where great opportunity exists. I could say cliche sayings: when others are fearful, get greedy. Great opportunities, risk premium. When people get extremely fearful, great opportunities to get long because everything's on sale and you're buying risk premium that you could see due to the edge that you've got available to yourself, and you're buying good companies. Going back to April last year, going back to any market this year, even right now, companies are falling due to fear of war, due to fear of revenue loss in the future. They're not falling because of revenue loss. They're not falling because they've lost money. They're not falling because they've done something wrong. They're falling because of general market risk, global economic policy risk. So companies that are inherently very strong, that naturally would be going up and to the right in a normal market condition, that continue to deliver time and time again, good, decent alpha or beta, they are being hit by the world's uncertainty at the moment. So that is why it's sensible to keep an eye on what's actually going on and get long. If you can, if you want to. I'm not saying do it. I'm just saying if you want to. Or stay out. Be cash, let the markets go higher or let them go lower and wait for whatever time you need to get involved. So I really don't know what's going on at the moment. I won't be able to do it during the stream, so I'll have to do it after. Let's look at the DXY. So yesterday we had that descending trend line level that we were talking about. Market traded into that. It's currently rejecting it. We've still got that 100 handle up above. Obviously, it's untested. It's at the extreme. Let's see how price starts to pan out today, because we've had a sweep of this structural high around 99.51s, which was a confirmed lower high. If markets are just using this as a fake break and a sweep, then we may even see the dollar index start trading lower. Again, that aligns with lower VIX, that aligns with higher index costs. So that will also in line mean that euro goes up. Okay. Yeah, I don't think there's much more to say on that. I can go down into the M15. Wowzers, streamy yard. So Monday into Tuesday, you know, Tuesday we were talking about markets in and around here, so between 9 and 10. Market obviously traded into that original level that we were talking about at the high, had a rejection, traded higher, and then we started to get that shift. So we had the high go, we had the low go, and then we're starting to see you know, something like this come into play, which you can see that we haven't quite hit that. So markets could come up for a little more. But if there's no more escalation, then the VIX should come down, the DXY should come down. The only thing that you have to maybe consider is that the euro's going to struggle because the ECB will be crippled by energy inflation. So that's something to maybe consider as well. So we could actually take a look at euro dollar now, because again, not much more to say on DXY. We can't trade it. We'll be looking at how we get into the euro anyway on the back of this. Sorry about this, everybody. If you're seeing what I'm seeing, sorry about this. So Monday, obviously expectations were for price to continue to the downside, which we got. From here, right, so there's always multiple scenarios, and I'm not that kind of guy that goes, oh, you're definitely going to do this, or we're definitely going to do that. We look at it from an agnostic, elastic perspective, and we try to understand what's going on right now. Now, overall, we're bearish, okay? But what we're seeing is a chain. Oh, why did I do that? Why? So we've seen this little change. We've got this. So markets are now ranging. What we need to see from here either is right way side action, and then we either get a break to the downside continuation, or we get break to the upside continue. And then we have to take into consideration what I've already said, okay, which is that if the DXY is going to go lower, the VIX will go lower and the euro should go higher. Now, again, the crippling part to consider is the ECB will be cuffed by energy inflation. So different scenarios. We have obviously bullish range out. We have bearish range out to the downside. Let's look at where they are on daily. Okay, so we're at a daily level. So, I mean, if this level does want to hold, then we could at least get a pullback into 117.40s. I think I just read. Yeah, 117.40s. $117.40s and then look for shorts. But remember, that's a daily level. If this is going to hold, this is going to be a fake move. We're going to target this higher. That's going to be 120s. Core 120s. Let's use this as our Yep, I mean, we're going to have to play this one by ear, aren't we? You know, being long the euro when there's energy inflation from Europe into the ECB, from obviously the world war at the moment. I can't I can't see much more than that at the moment. I really think that if the DXY is going to come off, the VIX will come off, the euro will go higher. So they're all playing out, and that of course doesn't necessarily mean that it's going to happen. But if we pull back into some form of resistance in the euro and the DXY pulls into some sort of support, then those ideas could flip on their heads immediately, and we could reinvigor shorts in euro and longs in the DXY. So no questions are coming in, no comments are coming in. So let's switch across to gold. Gold is the shiny metal puppy right now. Everyone wants to be in gold. And do you know what? I've seen more people go margined and blow their account in gold this week than since last year. Okay, so we discussed this yesterday. We discussed the theory and idea that this high could actually hold. I know we don't have the theory box on here at the moment. We got rid of that whilst we were talking, but we had that high supply potentially is showing the high in gold, and we would actually reject off of that level. Now, if we look at what's actually happened today, we rejected that level really hard. You know, we dropped from a high of just under 5,400 to a low at the time of 49s. And right now we're trying to recover. Again, we have to think, do we see further escalation in the war? Is there a reason to keep being long gold? These are the questions you need to ask yourself when you're trading, when you're investing. You know, we've got these levels up here. I think what time was this? This was 3 o'clock. Yeah, okay. So we were all, obviously the drop was about in and around here when we were talking. So we were looking at how we could get short. As you can see, we couldn't get short. There was no reason for us on the hourly time frame, at least, to get short. They're the levels that potentially would have been an area for us to get short on that. Because of the momentum, there may be opportunities to have got short yesterday during the leg, which I think we could probably see already. 9.17 rounded out into 10. So there may have been, silly. There may have been an opportunity to get short inside here, somewhere around here, and then maybe somewhere around here. And then you may have wanted to try and get short somewhere in here. I don't know. It's up to you. Obviously, the questions there are, why would you be getting short when supply is failing? Always ask yourself, or you ask yourself, what has happened to the left? You know, what have we broken? Bearing in mind, this is a bullish move. We're still bearish at this point, right? Come off of this. This has failed to break this. So this is now weak. This trades up. We break that. We then come back in. We respect that. So from here, you want to be thinking, all right, I don't want to be short at the moment. So there's two things. Do I want to be long? Well, there's three things. Do I want to be long? Do I want to wait for higher prices to get short? Or do I just want to sit out and be in cash? They're the three things. But the two things really cover both of them, which is, one, be patient and wait to look for further shorts. Or two, be long. That's it. It's really that simple. You know, do I get long? Do I not? So if you had got long because you're seeing supply failing and demand holding, then similar scenario, you're looking for momentum inside this market. Maybe you could have got long inside here. Initial areas that you want to be looking at and thinking, okay, market could stall is there. That's the first port of call for a resistance level. So let's say we got long here, right? What is it to this? Just under 1R. 1R. Is it worth your risk reward? Entirely up to you. You know, 1 to 1, 1 to 1.5, 1 to 2 is obviously always something that many investors and many day traders will look at. In this scenario, you would have been like, well, if that supply level is going to hold and we're going to start shifting shorts, I need to look at risk premium here and go, right, I've only got 1 to 1. Do I just sit out? Or is it worth me being involved? You know, could we get more? Well, you could get more. You know, probabilities say that you could get more, but it's almost like saying, let me walk across the motorway, the freeway, the autobahn, and not get hit by a car during prime hours. And I'm not saying dodge, I'm saying walk. Walk. The probabilities are against you, but there is a probabilistic chance that you could not be hit. It's dependent upon how much percentage and, I guess, data you have within your edge that says, well, if I walk at this angle, at this speed, like this, based on this type of car or these types of vehicles, I could make it across. But if it's only 3% or 5% or 10% chance that you're going to make 1 to 1, you kind of have to weigh it up whether it is for you. If you trade 1 to 1, then yeah, all day long there's an opportunity available there again. Stop loss will also remit how you get involved, where you're going to be trading from. There are people out there that also trade negative RR, so they might have been looking at, you know, more like a 2R loss with a half an R profit target. That's what some people do. I'm not saying you do that. I'm not saying you should do that. I'm not saying anyone does that. These streams are here for education and somewhat entertainment. They're not here to give you trading advice or signals or really have any actionable trade ideas. These are just ideas to help you generate theories and thesis and go away and study. So where are we now? We're ranging, very much so. You know, you look at the price here, we've got a fake breakout to the downside. We can't take the high, we then get a low, but markets overall are struggling. It does look like gold wants to fall from here, but we are ranging at this moment in time. So do we start looking for shorts in gold? Again, size down if you're going to, because at this moment in time, markets are disgusting. Markets are horrible. Short term, you know, risk premiums are there for longer term plays and maybe swings and positions, but definitely not easy in this short-term environment. So wouldn't be getting short from here. I'd be waiting if I was looking for shorts. So again, I want to see momentum in the market. And why do I say that? So look, demand has been respected. Supply has been respected. Demand has tried to fail. We've got this here. It's pretty much an equal sweep or an equal break. We've then traded higher. At the moment, supply is still being respected. So from here, with this being a sweep, we either see this. Oh, why hasn't it done it? We either see this or we see this. And I'm okay to sit on my hands until that happens. I don't need to be involved in this long or this short until it confirms. The shorts are looking good, in my opinion. From this level or not, I don't know. But again, let's look for a break. Let's wait for momentum to kick in, and then we could consider getting shorts, and vice versa. If the longs play out here, we'll be looking for other areas to get long from. And again, momentum and volume really are the key indicators here, everybody. We're not looking at calling the market before it happens. We're looking to trade the market whilst it's happening. So final session to round out on, yeah, it's completely not an asset for the faint of heart. Gold and the Dow are notoriously called the widowmakers for a reason, and that's because most people that trade them lose everything. Some people don't. You know, like I said, I was very blessed to be associated and surrounded by what I would deem one of the most decorated and arguably one of the best metals traders in the UK. Did of course work worldwide, did work out in New York, did work in the markets around the world. Certificated, decorated, regulated license, held pretty much most, if not all, of the certificates that you could possibly hold across, for example, like the LME. So, wow. Am I seeing things? Okay. All right, so we spoke about Bitcoin here. We were looking at this demand level and stating that, again, two scenarios could happen. Bitcoin could continue to fall from here if there is further escalation on the war. If there's de-escalation, we will look for the trades higher. Now, as you can see, the latter panned out, which was the traded into this level. We tried to trade up, and these are the key points. You're not long. You're not long here. You are not long here. Okay, you are nothing. Not you are nothing. You're not. You're not long. Right. What then happens? We come back down to retest that support level, that demand area. We sweep the low. We break the low on a fake breakout. We then trade higher. Now, this is the last point of supply. From here, you could start to look at how you're getting long. Again, on the 15-minute, it doesn't look like it's as easy as there to get long from inside here, because what happens, we trade up, we come back down. We do revisit that previous supply, which now turns into support, and we trade off from there. So I suppose you might have been looking for longs in somewhere around here, but you were caught up in the range and you were trading in the sideways market. Alternatively, similar scenario, what happened? Why is supply holding? If demand is in control, we get another sweep. And then from there, again, subjectively, you're still trading in this range. But if you're trading the extremes, be it the short or the longs from this range, and you're seeing momentum kick in, you can then obviously subsequently look for either a short into the lows or a long into the highs. And then from there, it's up to you whether you're holding the short down or whether you're holding the longs for higher prices. You know, I don't know whether markets are magnetized to our white squiggly lines on the chart at the moment. That's a joke. Don't worry. I'm completely confident that they're not. It was more of a sarcastic remark. But as you can see, we had 71 200s drawn in the sand for our target. Markets hit that, as you can see. Which, again, this is kind of suggesting that de-escalation is on the cards. Do we get a pullback today? Probably. You know, there's a couple of potential areas of demand that we could look at. This would be the nicest area. There are better areas down here, but that would be the nicest area of the ones I'm seeing. So 69.2 to 69.6 is potentially a probable pullback area. I mean, it's a bit deep, but it could happen. So let's see what happens. I'm going to just quickly do this. Again, based on no further escalations, based on de-escalation, based on no further escalations, i.e. de-escalations, based on further escalations. Let's see how we pan out for the rest of the week. But again, listen, everybody, thank you so much, every single one of you, for joining. It's always an honor and a pleasure. I truly, value every single one of your views. I truly value the opportunity to be presenting to you and hosting to you live on a daily basis. I would like to do live streams independently, because that way we can actually trade. I'd like to actually do live streams across the European session and the US session, because again, if I do it as an individual person, that doesn't reflect the views of the company, and I actually do it more of an independent scenario, and I'll just be quite free and independent. We can talk about trades. We can actually hit trades together. We can take losses. We can blow accounts just to show you what you shouldn't be doing. We can get long. We can get short. We can actively trade and teach risk management. But let's see. You know, at the moment, I am the host here for Seacrest Markets. Again, always a pleasure, always an honor. And I'm here until they'll have me. That's pretty much what I always say. So listen, as always, please trade safe, trade smart, and of course, trade Seacrest. If you're not trading with us, please trade safe, please trade smart, and I look forward to seeing you all in the markets. Again, if you need any comments, if you've got any questions, any queries that you're embarrassed to ask in public, please feel free to DM me on X at Trader Warner or on Instagram, which is Trader_Warner. I'm not very active across social media for influencer type of things, but I do try to check in on my social medias on a daily basis just to see how things are going and just to check in with all of the noise that goes on around that kind of world. But everybody remember that, you know, the markets are going to be here tomorrow. Don't force trades. Trade safe, trade smart, and have an exceptional trading day. And I will see you all in the coming streams. Thank you. God bless and take care.
Patterns emerging, psychology's key. Discipline strong, no greed in the spree.